Hi, this video is very important for all the students who are studying Advanced Financial Management, ACCA P4 paper or CMA Part 2. So in this video, I'm going to discuss how to calculate modified internal rate of return. Why modified internal rate of return, which is MIRR, is calculated and how it is better than IRR. Hi, I'm the Commerce Specialist. Welcome to my channel where you'll find videos covering learning outcomes of various academic qualifications and professional certifications, including life-changing business ideas and hacks. So let's jump into the discussion where we calculate MIRR, which is called Modified Internal Rate of Return. Guys, before we get into Modified Internal Rate of Return, I strongly suggest and recommend that you watch my video on investment appraisal, where I have discussed all the 4 tools of investment appraisal, which is payback, NPV, ARR and IRR. Now, modified internal rate of return is an improved version of IRR. Now, as we know that when we calculate IRR, there are multiple answers possible because it's a trial and error. Here you need to understand the meaning of IRR. IRR is that rate at which NPV is 0. So we don't know exactly the rate. Yes, in my video investment appraisal, I've explained you there are 2 methods. One is trial and error. You keep trying until you find what is the IRR, means a rate at which you get NPV 0, which means there are multiple IRR possible. The benefit of calculating modified internal rate of return is that you only get a single answer. Another reason you need to understand before we get into calculating modified internal rate of return is that IRR assumes that whatever returns we are getting from the project, they are invested at IRR rates. Let's say IRR is coming 15%. So whatever returns we are getting from the project, they are invested at 15%. Whereas in reality, it is not the case. It is possible that whatever returns we are getting from the project, we may invest them at our discount rate, which is cost of capital, or some other better rates. So the deficiencies of IRR, which is internal rate of return, is fixed by MIRR, which is modified internal rate of return. So let's see how it is calculated. I have created 2 different questions. One is a simple one is a little complex one. In both we will be calculating MIRR. So here in a simple question, if you look at, we have cash flows given year 0, 10,000 in bracket means initial investment. Year 1, 2 and 3, you have the returns, cash flows here. Our discount rate is given to us as 10%, which is the cost of capital, and it is assumed that the returns which we are getting are invested at 8%. Now again, before we move on calculating MIRR, you need to understand how to calculate future value and present value. So let me give you a very quick recap of calculating future and present value. Now understand there is something called 1 plus r to the power n, where 1 is in the formula, r is the rate of discount rate. Let's say if it is 10%. Power n is, let's say, for 3 years. So if I put 3 here, so 10% would be 1 plus 0.1 to the power 3. If I multiply, this will be 1.331. So if I want to find the future value of any amount, what I have to do is I have to take that amount and I have to multiply it by 1 plus r to the power. Now it could be, if I want to find future value after 3 years, I will take the power 3. A future value after 2 years, I will put 2. So let's say 1000, if I want to find its future value after 5 years, so it will be 1000 into 1 plus r to the power 5, which will be 1000 into 1.1 if discount rate is 10%, power 5. When you solve this, you will get the future value. Likewise, if you want to find the present value, what you do is you write the amount, whatever is the amount, and you divide it by 1 plus r to the power n. So let's say the amount is 1000 and you want to know this 1000 you are getting after 1 year and you want its present value, so you divide it by 1.1 and after 1 year means 1 year. So this 1000, if you're getting after 1 year, you divide it by 1.1 power r, you will get its present value. Likewise, let's say you're getting an amount 3000, this is you're getting after 3 years, but you want to know the present value. So what you do is, you divide it by 1.1 power 3. So when you divide, you will get the present value of this 3000 which you are going to get after 3 years. What is the value today? That is the present value. So these calculations of future and present value I have discussed in detail in my video of investment appraisal. There I've also explained you how to look at present and future value tables, which are comparatively easier. So I'm assuming you have seen my video on investment appraisal, or you already know how to calculate present and future values using the tables or manually, because this topic is for advanced financial management. So let's look at MIR. Here if you look at again, the initial investment is 10,000, the cash flows are given, discount rate is 10%, reinvestment rate is 8%. To calculate MIRR, we need two information. Number one is the present value of initial investment. In our case, it is 10,000 and it is at year 0, so it is the present value. We don't need to do anything about it. So the present value of initial investment in our case is 10,000. And you need the future value of these amounts. Future value. And future values, these returns from the project are reinvested at 8%. I told you to find future value, you have to multiply the amount by 1 plus r to the power n. So if we look at this 3000, we are getting it in year 1. If we invest it throughout the life of the project, this will be invested for 2 years. We are getting it in year 1, it will be invested for year 2 and year 3. So the future value of year 1 cash flow, which is 3000, will be 3000 multiplied by 1 plus r. Understand our reinvestment rate is 8%. So R is 8%. 8% means 0.08. So this will be 1.08. And remember, this 3000 is invested for another 2 years. So power 2. Likewise, this 4000 is invested for 1 year. So the future value of year 2 cash flow, which is 4000, we want to find its future value 1.08, that means into 1 plus r. For this 4000 remain invested for 1 year, power 1. And the future value of year 3 cash flow, which is 5000, you don't need to do anything because you're getting this in 3rd year, so it is not invested for another 4 years. So this will be 5000. So using the calculator, 3000 into 1.08.2 will give you 3499.20. 4000 into 1.08, which is 1 plus r power n. 1.08 power 1 is the same. 4000 into 1.08 will give you 4320. And this 5000 remains the same. So let's add all the future value of the cash flows from the project. If you add all of them, you get 12,819.20. So this is your future value of cash inflows, because this is the cash coming in, which is without bracket. This is the cash going out, which is with brackets. So the formula of MIRR, modified internal rate of return, is equal to future value of cash inflows divided by present value of initial investment to the power 1 upon n, whole thing minus 1. So if I plug in the numbers, future value of cash inflows, this is future value of cash inflows, which is 12,819.2. Present value of initial investment, as I said, you don't have to do anything to this because this 10,000 is in year 0, so that's the present value. So I can take this here, 10,000 to the power 1 upon n is the life of the project. The life of the project spans over 3 years. So this is 1/3 minus 1. So what you have to do is first you divide this. Whatever answer you get, you have to do it to the power 1/3 means to the power 0.3333. Whatever answer you get, minus 1. So finally you will get 8.63%. This is your modified internal rate of return. Now, what is the decision criteria? Originally, again, if you refer to my video on investment appraisal, where I calculated NPV, IRR, everything, so especially for IRR, the decision criteria is if IRR is more than cost of capital, we should accept the project. Now here what is happening, your discount rate is 10% and your modified IRR is 8.63, which means if we are investing our future cash flows from this project at 8%, it is giving us a return which is less than our cost of capital. So we have to be careful here. This is not very advisable to invest it at this percentage. We should find better avenues to invest the returns from this project. Otherwise, we don't want to continue this project. Now let's have a look at a complex question where modified internal rate of return is calculated. So guys, in this question, what is happening? In year 0, we are investing 700,000. In year 1, we are also investing 300,000. So from year 0 to 1, that means in 12 months, total investment is 1,000 or 1 million, whatever you call it. So year 0, you're investing 700. Year 1, you're investing 300. So in 12 months, you're investing 1,000. Okay. From year 2, you start getting the cash flows, positive cash flows, 400, 600 and 300. Here, the detail given to us is the cost of capital, which is discount rate, is 10%. IRR already calculated is 10.59. Reinvestment rate is also 10%. Now, reinvestment rate could be different, but I've just kept 10% to make the question easy. So let's understand how do we calculate modified internal rate of return where the cash inflows are spread over a number of years and there are more than one cash outflows and obviously multiple cash inflows. So what I'm going to do here is I'm going to divide this question into investment phase and the return phase. So if I look at the investment phase, this is the investment phase and this is the return phase. So first what I'm going to do is I'm going to calculate the present value of investment phase. Which is obviously 700, it's 700 means 700. So cash flow for year 0, the present value is equal to 700. But you see, this is invested in year 1. So what will be the present value at year 0? So what you do is you take cash flow of year 1. Okay, if you want to find the present value, you take this 3,000, okay, and divide it by 1 plus R. Remember the discount rate is 10%, so 1 plus R would be 1.1. And obviously this is 1 year, so I'm doing 0.1. So this comes to 272.72. Okay, so if I add these two, this will be 972.7273 whatever. Okay, so this is the present value of cash, or you can say present value of initial investment. Just like here, we wanted present value of initial investment, we have present value of initial investment. Now the second stage is the return stage. Here we need to calculate the future value of cash inflows. So please remember, what you're getting in year 2 is invested for another 2 years. This 400 is invested for another 2 years. this 600 is invested for 1 year and 300 remains the same. So we can calculate the future value of year 2 cash flow, which is this amount. This 400 you can multiply by, obviously to calculate future value you have to multiply it by 1 plus R. Now R is 10%, so you will multiply it by 1.1, and obviously this 400 will be invested for another 2 years, so 1.1 power 2. And then the future value of year 3, which is this amount, the cash flow of year 3, which is 600, this goes invested for another 1 year. And the last cash flow, which is future value of year 4, the cash flow of year 4 is 300. You don't need to do anything, it will remain 300 because it is getting in year 4 and the future value, it's not invested for any further year, so it will be 300 only. So let's see what you get here. 400 into 1.1 power 2 will give you $484. 600 into 1.1 will give you 660, and 300. So let's add all of them. You will get future value of cash inflows, which will come to $1,444. So guys, here again we will plug all the information into the MIRR formula. So the formula for modified internal rate of return is MIRR is equal to future value of cash inflows divided by present value of initial investment, whole thing to the power 1 upon n, and then the entire answer you minus 1 from that. So here future value of cash inflows is 1,444. Present value of initial investment is 972.72. Whole thing to the power 1 upon n. 1 upon project life is still 4 years, so 1 upon 4, whole thing minus 1 will finally give you 10.38%. Obviously, when you divide this, multiply to the power 1 divided by 4, when you minus 1, in the end, final answer you multiply by 100. So you get in percentage, 10.38%. Especially for ACCA student, I am giving you an alternate formula which will still give you the same answer. So let's have a look at an alternate formula for MIRR. Because of lack of space, I am writing the alternate formula especially for ACCA students to calculate MIRR, modified internal rate of return. MIRR is equal to nth root of terminal cash flow divided by present value of initial investment, and when you solve all this you minus 1. Let me tell you, terminal cash flow is the same as future value of cash inflows. So you can plug in the numbers 1,444 here, over here present value will be 972, nth root would be 4th because n is the life of the project, and whole thing minus 1 will still give you 10.38%. Now guys, here I want to tell you why MIRR is preferred over IRR. There are many investment appraisal tools. NPV is always considered better than IRR because IRR can give you multiple answers. But if you compare IRR and modified internal rate of return, modified internal rate of return is far better than IRR because there is only one answer to it. But if you calculate IRR of the project, it may give you multiple answers because like if you calculate NPV at discount rate of 10% and you're getting a positive NPV, you have to increase the discount rate to get a negative NPV. Now when you increase the discount rate, some will take 15, some will take 20, some will take 40. Either ways you will get IRR, but the rate will be different. So if you have seen my video on investment appraisal, you will see how IRR is calculated and you can get different IRR. But the beauty of MIRR is that it's not multiple answer, one answer. So if you have understood this topic, please let me know in the comment. If you're not yet subscribed to my channel, please subscribe and press the bell notification button so that you get my videos on a timely basis. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time. Love you all.